Hello and welcome back to the TheRockFXHub. I'm Peter, or as most of you know me, Peter the Rock. It's a pleasure to have you here as we begin this exciting journey through my new audiobook and video training series titled Forex Trading Fundamentals, a complete beginner's guide. This series is designed especially for those who are ready to finally understand how the Forex market truly works, from the very basics to advanced insights that professional traders rely on every single day. Whether you're completely new to trading or you've been in and out of the market without clear results, this book will guide you step by step in plain language and practical examples. Throughout this series, we'll be covering each chapter from the book in separate videos and audio sessions. Some chapters that are shorter may be combined into one video. But don't worry, I'll make sure every section is explained thoroughly so you can follow along easily and build your knowledge gradually. Now, before we dive in, here's what you can expect from Chapter 1, Understanding the Forex Market. In this first chapter, we'll cover Keycap 1, what is Forex trading? Understanding what happens when you buy and sell currencies. Keycap 2, the history and evolution of Forex. How the market developed into the $7 trillion a day global powerhouse we know today. Keycap 3, why trade Forex? Exploring what makes this market so attractive and how to approach it wisely. Keycap for the key players in the Forex market, from central banks and institutions to retail traders like you and me. Each of these sections builds a foundation for everything that follows. So, even if you've traded before, I encourage you to listen carefully. Sometimes the most important breakthroughs come from relearning the basics, this time with the right perspective. And if you're new here, remember to subscribe, like, and share this video so you don't miss any updates. Each time I upload the next chapter or training module, you'll receive a notification, so you can keep learning in real time and continue growing as a trader. Now, get comfortable, take your notebook if you have one, and let's begin our journey into the world of Forex trading. Welcome to Chapter 1, Understanding the Forex Market. Foreign exchange, Forex or FX, is a global marketplace where currencies are exchanged. Unlike stocks that trade on centralized exchanges, FX is an over-the-counter, OTC market, a worldwide network of banks, dealers, electronic platforms, and institutions quoting prices to one another around the clock, 5 days a week. This structure lets trading roll from Sydney and Tokyo to London and New York with only brief weekend pauses. In April 2025, average daily turnover in OTC FX reached about $9.6 trillion, underscoring its position as the largest, most liquid financial market on Earth. At its core, a Forex trade is a simultaneous purchase of one currency and sale of another, always transacted as a pair, for example, euro to US dollar or pound sterling to Japanese yen. If you expect the euro to strengthen versus the US dollar, you might buy euro to US dollar. If euro rises relative to USD, the position gains value. Price quotes are simply exchange rates, e.g. 1.1000 means 1 euro costs $1.10. The scope of participants is broad. Central and commercial banks, asset managers, hedge funds, multinational corporations hedging cash flows, proprietary trading firms, retail brokers, and individual traders. Importantly, the market's decentralized design has evolved with electronification. Today, non-bank liquidity providers and multiple venue types blur the old inter-dealer/dealer-to-client divide. Because currencies reflect national economies, macro forces, interest rate expectations, inflation data, employment, trade balances, and geopolitical risk are the primary drivers of FX trends. Traders interpret these through two complementary lenses: fundamental analysis, economic/news catalyst, and technical analysis, price structure, momentum, and patterns. The best practitioners learn to weave both. Charts show what is happening. Macro explains why. FX's accessibility is a double-edged sword. Retail traders can open accounts with modest capital, but the same OTC structure that creates flexibility also demands discipline and skepticism. U.S. regulators, for example, emphasize that retail off-exchange forex is risky and frequently misrepresented. Education and risk controls are essential. A few core microstructure ideas help demystify how prices move. Quotes show a bid what dealers pay and ask what they sell at. The spread is the difference, effectively your immediate transaction cost. Price changes are measured in pips, percentage, and point. For most major pairs, 1 pip is 0.0001 of the quote. Many brokers also display pipettes, an extra decimal place for finer ticks. Trade sizes are expressed in lots, standard 100,000 units, mini 10,000, micro 1,000. FX is renowned for leverage, which allows you to control a position larger than your deposit margin. While leverage can magnify gains, it equally magnifies losses. Regulators require standardized risk disclosures and minimum security deposits for retail accounts. Sensible position sizing, predefined stop losses, and risk-to-reward planning are non-negotiable. The market's 24/5 rhythm fosters distinct session personalities. Liquidity and volatility typically build to the London Open, peak during London-New York overlap, and cool during the late U.S. afternoon ahead of Asia's reopen. New data releases, e.g. CPI, jobs reports, central bank decisions, can spike spreads and slippage. Professional calendars and disciplined event plans help mitigate surprise. For newcomers, the FX learning curve is less about discovering a holy grail indicator and more about building a repeatable process. Define the trading session and pairs you'll specialize in. Track a small set of economic catalysts. Use a simple, testable method to read trend, momentum, and key levels and manage risk ruthlessly. Because the market is OTC and intensely competitive, edge comes from preparation, not prediction. Finally, remember that liquidity is context-dependent. Major pairs, euro to US dollar to Japanese yen, pound sterling to US dollar to Swiss franc, usually offer tighter spreads and deeper books than minors or exotics. An important consideration for execution quality and risk. So why is FX so enormous? In part because currencies are the lifeblood of global commerce. Every cross-border purchase, investment, merger, or remittance implies someone exchanging money. Institutions hedge future cash flows with forwards and swaps, while speculators and macro funds take views on growth and policy differentials. The BIS reports that swaps now account for the largest share of turnover, reflecting these hedging and funding needs. Bank for international settlements. The decentralized architecture also broadened participation. Electronic venues, streaming quotes, and API connectivity let banks, non-banks, and algorithmic market makers compete to provide liquidity. The once sharp line between interdealer and dealer-to-client trading has blurred as new liquidity providers entered and execution styles multiplied. RFQ, streaming, dark/ECN pools, internalization. For the individual trader, this means two things. First, prices you see are composite outcomes of many venues, not a single exchange print. Second, market conditions can shift rapidly as liquidity migrates between sessions and as news reprices expectations. Building a routine. Pre-market prep levels scenarios and if-then plans. Helps you adapt. Risk transparency matters. U.S. regulators caution that majority of retail FX accounts lose money over time. This is not meant to discourage, but to align expectations and emphasize education. The edge for a newcomer is process fidelity, small risk per trade, consistent execution, relentless journaling, and patience. Practically, start with a handful of liquid pairs aligned to your schedule, e.g., euro to US dollar or pound sterling to US dollar for London/New York. Australian dollar to US dollar, or US dollar to Japanese yen for Asia. Observe how spreads behave at session opens, during data prints, and near major technical levels. These micro lessons compound into durable intuition. Let's knit definitions into a concrete example. Suppose euro to US dollar equals 1.1000/1.1002 bid/ask. A 0.2 pip spread on a high liquidity venue. You buy one standard lot, 100,000 euros. A 1 pip favorable move to 1.1001/1.1003 now lets you exit near the bid, capturing roughly $10 per pip on a standard lot. After spread, you net slightly less. Scale that up to a 20 to 30 pip intraday swing, and you see why traders pursue liquid majors first. Pip valuation varies by pair and quote convention, but the mechanics are just a start. Price behavior reflects order flow around widely watched levels, prior highs/lows, round numbers. Market structure, trend versus. Range and volatility regime, quiet Asian session versus. Active London/New York overlap. Many traders blend technical tools, like moving averages for trend bias, momentum oscillators for overbought/oversold context. With price action cues, breakouts, pullbacks, rejections, the tools are less important than consistency and clear risk parameters. Macro catalysts supply the why. Central bank policy shifts, inflation surprises, and employment data can reset currency trajectories for weeks. An unexpected rate hike typically supports a currency as higher yields attract capital, though the reaction depends on how the outcome compares to consensus expectations. Given leverage, implement pre-trade risk caps, e.g., less than or equal to 1% of account per idea, and hard stops. Regulators require risk disclosures because leverage cuts both ways. A small adverse move can be outsized when position size is large relative to equity. Build habits. Check the economic calendar, note key times, and scale down during volatile releases. FX differs from equities in that there's no earning stream, only the relative value between two economies. That makes interest rate differential central. When a central bank signals tighter policy, its currency often strengthens if markets are underpricing that path. Conversely, dovish pivots or political instability can weaken a currency as investors demand higher risk compensation or move capital elsewhere. Market size and leadership evolve. Surveys indicate London remains the largest hub, with the US, Singapore, and Hong Kong also critical. The dollar is still dominant across transactions. Other shares shift over time as policy, liquidity, and market access change. Understanding where liquidity concentrates helps with execution. Pairs most active in your trading window typically offer better fills and smaller slippage. Because the market is OTC, broker selection matters. Pricing execution model, audiobook/STP versus. Internalization, margin policies, and regulatory status shape your trading experience. U.S. and other regulators repeatedly warn about aggressive marketing and unrealistic performance claims in retail FX. Healthy skepticism, due diligence, and starting small are prudent. Above all, treat FX as a skill. Build your glossary, pip lot, margin, spread, your toolkit, charts, calendar, journal, and your rules, setups, risk, review. Small, repeatable advantages. Executed consistently. Compound. To recap, Forex trading is the act of exchanging one currency for another to express a view on their relative value. It occurs in the world's deepest OTC market, which now turns over nearly $10 trillion daily. Liquidity that enables flexible access but also demands discipline. You'll trade pairs, measure moves and pips, pay the spread, and decide whether to lean on fundamental, technical, or blended approaches. Your next steps are practical. Choose when to trade sessions and what to trade, a short list of liquid pairs. 2. Track a few macro drivers and plan around scheduled releases. 3. Define a method to read market structure and momentum. 4. Enforce risk rules, position sizing, stops, max daily loss. 5. Journal relentlessly to convert experience into edge. Session-aware trading. London momentum, New York overlap volatility, Asia range dynamics will anchor your expectations about spreads and movement. Finally, a candid reminder, retail FX can be high risk. Regulators note that many retail accounts lose money, often due to overleverage, poor risk controls, or unrealistic expectations. That reality is not a deterrent, but a compass, pointing you toward education, process, and patience. With those pillars, Forex becomes not a gamble, but a profession you can grow into. History and evolution of Forex. Currency exchanges as old as commerce itself. Ancient merchants needed to swap one form of money. For example, Greek drachmae. For another, such as Egyptian coins, in order to facilitate trade across cultural and political boundaries. The phenomenon of money changers appears in historical records from the 4th century AD and earlier, where gold or silver coins were exchanged for other denominations. By the early modern era, say the 16th to 18th centuries, key trading hubs like Amsterdam began to formalize currency exchange, and finance scholars note that what we now consider Forex has roots in those early mercantile markets. Some sources trace the institutional origins of Forex trading to Amsterdam roughly 500 years ago. In the 19th and early 20th centuries, the gold standard system dominated. Major countries pegged their currencies to a fixed amount of gold or a currency tied to gold. This provided stability and predictable exchange rates, but war and economic stress exposed its vulnerabilities. After World War I, many nations abandoned the gold standard or suspended convertibility, opening the door to a more flexible currency regime. The post-war era brought a major shift. The Bretton Woods Agreement, 1944, established the U.S. dollar as a reserve currency, pegged to gold, while other currencies were pegged to the dollar. This system persisted until 1971 to 73, when the dollar's gold convertibility ended and major currencies began to float. Thus began the modern foreign exchange environment. Floating currencies, large institutional players, electronic trading, and ultimately the retail era. The evolution mirrors the broader transition of finance. From printed ledgers and telephones to real-time, global digital platforms. The transition to a floating rate regime in the early 1970s was a watershed moment for the Forex market. With the collapse of the Bretton Woods fixed exchange rate system, currencies were free to find their own levels driven by economics, policy, and market sentiment. This shift also spurred the growth of professional FX trading rooms in banks and major financial centers. Technological advances in the last few decades transformed how Forex trading is conducted. In the 1980s and 1990s, electronic platforms began replacing phone calls. By the late 1990s and early 2000s, online retail brokers emerged, allowing individual traders to access spot FX. One commentator notes that pits to pixels capture the shift from physical trading floors to global internet execution. Simultaneously, the nature of participants and instruments expanded. What was once largely interbank and corporate activity evolved to include hedge funds, algorithmic traders, retail speculators, and complex derivatives, forwards, options, swaps. A 2024 review by the Federal Reserve Bank of New York pointed to increasing complexity in participants, venues, and instruments in the FX ecosystem. The shift also changed the pricing and execution model. Spreads compressed as electronic communication networks, ECNs, and prime brokers provided alternate liquidity. Settlement protocols improved, yet regulation lagged. Regulators identified that many retail clients lose money in FX and that leveraged OTC trading carries elevated risks. The evolution to today's market. 24 hours a day across global sessions, ultra-fast electronic quotes, retail access, and algorithmic trading creates extraordinary opportunity, but also elevated complexity and competition. Understanding that heritage helps traders appreciate how we arrived at the current structure and why margin, leverage, execution, and risk remain so critical. One significant milestone in the evolution of Forex was the creation of the Eurozone single currency. The Maastricht Treaty, 1992, set the foundation for the euro, which launched in 1999 as a virtual currency and circulated from 2002. The example of merging multiple national currencies into one underscores how global monetary architecture influences the FX market. Another key development was online trading's democratization. Platforms in the late 1990s and 2000s let retail investors access spot FX and derivatives, once reserved for institutional participants. For example, the ECN platform Matchbook FX, founded in 1999, is cited as a catalyst in opening up FX to a broader public. Liquidity flows have evolved too. The core trading hubs remain London, New York, Tokyo, and Singapore. But shifts in time zones, regulatory frameworks, and technology echo in how these markets behave and how traders execute. The interbank voice trading rooms of old have largely been replaced by electronic matching, automation, and algorithmic execution, often spanning high-frequency microstructures. Crisis events also shaped evolution. For instance, the 2008 global financial crisis triggered major reevaluation of counterparty risk, settlement systems, and transparency in FX. The subsequent regulatory responses, e.g. Dodd-Frank in the U.S., influence how brokers, banks, and traders interact. While FX remains OTC, clearing, transparency, and regulatory oversight are significantly different from earlier decades. Thus, the history and evolution of the Forex market is about more than dates. It's about structural change, from barter to gold standard, from fixed rates to floats, from banks to algorithms, from voice rooms to retail screens. That historical context gives traders perspective on why market behavior, volatility, and liquidity patterns exist today. Looking forward, several trends are shaping Forex's next chapter. Digital assets and crypto linkages, increased regulatory scrutiny, and the growth of algorithmic and AI trading are likely to influence how currency markets function. The New York Fed Review emphasizes that the FX market is increasingly complex in terms of instruments, venues, and participants. Volume growth has been relentless. Recent BIS data showed daily FX turnover already exceeding $7 trillion and trending upward as new regions and retail access expand. But while size grows, execution quality, liquidity fragmentation, and risk management concerns persist. Platforms, mobile access, and automation raise both opportunity and complexity. For the beginner trader, appreciating this evolution matters because it explains why today's market works the way it does. 24-hour windows, overlapping sessions, ultra-tight spreads in major pairs, deep liquidity mixed with occasional thin pockets, fast information flows, and algorithmic reactions. With that awareness, a trader can build better habits. Adapted to the modern ecosystem instead of trying to trade like it was 1970. In short, the Forex market did not appear ready-made for the retail trader. It evolved across centuries of economic change, technology leaps, and regulatory shifts. Your objective as a new trader is to honor that evolution by trading with respect, process, and preparation. The chapters ahead will show you how to apply that understanding in practice. Why trade Forex? One of the primary attractions of the FX market is accessibility. Unlike some financial markets that require large capital or operate within restricted trading hours, the FX market is open 24 hours a day, 5 days a week, and accessible via online brokers with relatively modest deposits. According to IG International, one of the key benefits is that you can trade around the clock, meaning you're not constrained by the opening and closing times of traditional stock exchanges. This flexibility permits people with full-time jobs, family commitments, or other responsibilities to engage in trading at times that suit them, be it during a lunch break, in the evening, or early morning. Beyond convenience, the FX market's sheer size and liquidity are compelling. The enormous volume of daily currency trades means more buyers and sellers, tighter spreads, and often smoother execution for major currency pairs. For instance, one study points out that the retail transaction cost in FX can often be less than 0.1% under normal conditions. For beginners especially, lower transaction costs and high liquidity reduce the friction and make a more favorable environment to focus on learning and strategy, rather than battling wide spreads or poor fills. Moreover, trading Forex offers the ability to profit from both rising and falling markets. Because every trade involves buying one currency while simultaneously selling another, you can go long if you expect a currency to appreciate, or go short if you believe it will depreciate. This two-way opportunity is highlighted by State Street in its list of FX benefits. Profit from both rising and falling markets. For traders who wish to exploit volatility and directional shifts, this flexibility is a powerful differentiator compared to markets where short selling may be cumbersome or restricted. However, accessibility and opportunity carry responsibility. The same ease of entry that makes FX appealing also means new traders must ground themselves in risk management, education, and realistic expectations. As future chapters will emphasize, treating FX trading as a skill-based discipline, not a speculative gamble, is essential. Another compelling reason to trade Forex is the capital efficiency afforded through margin and leverage. In the FX market, you often only need to deposit a fraction of the full position size as margin. This enables controlling a larger currency exposure with relatively small capital. As pointed out by Charles Schwab, this means you can establish a position with a relatively small amount of money. While this feature amplifies profit potential, it simultaneously increases risk. Small price movements can result in large losses if not managed properly. Crucially, for beginners seeking to build skills, this leverage means they can participate meaningfully even with constrained resources. That said, leverage must be paired with discipline. Many regulatory bodies stress that retail FX accounts often incur losses due to excessive size and poor risk controls. Therefore, part of the appeal of FX trading lies in the possibility of starting small. Learning, refining process, experimenting with demo/demo live accounts, and escalating only once the skills, plan, and emotional control are in place. Liquidity is another major benefit. With average daily volumes in the multi-trillion-dollar range, major currency pairs offer tight spreads, deep books, and the ability to enter/exit trades efficiently. This matters because execution quality influences the true outcome of trading activity. Smaller gaps, tighter spreads, and speedy fills all reduce the hidden cost of trading. For someone at the beginner stage, choosing liquid pairs means fewer surprises and more consistent learning opportunities, rather than chasing illiquid or exotic pairs with wide spreads and poor fills. Finally, the fact that FX is inherently global means you're not restricted to one region's economy or stock market. Your trading horizon perceives the world, from U.S. non-farm payrolls to Japanese yield decisions and Australian commodity exports. This global breadth makes the FX market a rich laboratory for those willing to invest in macroeconomic understanding, time zone awareness, and price behavior. A further, but not all will succeed. This underscores why trading must be approached with humility, education,